just about 3 hours' time, we'll know whether the Reserve Bank's decision on interest rates is positive or negative. The Monetary Policy Committee has been meeting since yesterday, and Governor Gill Marcus will announce the decision shortly after 3 o'clock. Join me to talk about her options. I'm joined by Tendani Mantshimuli, consumer economist at Liberty Life, and Sizwe Nxedlana, senior economist at FNB Commercial. Thanks both very much for coming in today.
Good afternoon.
Tendani, I'll start with you. We had Gill Marcus speaking at the BER conference last month and giving a strong indication that there wouldn't be another cut in interest rates at this meeting in particular. Do you think anything's changed since then that could actually force her arm?
No, I don't think there's anything material that has come forth. As she took pains to explain last time, a month of negative data doesn't necessarily lead to a change in interest rate stance. I was actually surprised with the last interest rate cut.
I think everybody was.
Yeah, I was expecting them to leave it unchanged. I still expect them to leave it unchanged for now. I think conditions are just too fluid, both globally and domestically. We don't know what the European situation is going to turn out like and what impact it has on South Africa. So I think it's best that they leave it unchanged for now.
Of course, we've had very mixed data over the past month or so, where we had manufacturing numbers out yesterday that were better than expected. We had those dreadful retail numbers out just before Gill Marcus spoke at that BER conference, and they looked pretty dire. I mean, what do you think? How do you think they're going to play it today?
Look, we continue to see an economy that's again driven by the supply side sectors, domestic demand remaining very weak. Over and above that, inflation, the South African Reserve Bank seems to be very positive about the inflation outlook. So again, over and above that, we've also been told that monetary policy is likely to remain flat for an extended period. So it's really it's almost boring to talk about it this time around, because it means that we're highly unlikely to see any change in interest rates. A change in interest rates in our assessments would be predicated upon a better than expected inflation outcome. In other words, lower inflation than what we currently expect, and or worse than expected growth recovery. We think that there is increasing evidence of the economy gaining traction, particularly on the supply side, but
and that's backed up by yesterday's manufacturing data.
Exactly, yeah. Even though it's coming from a very low base. But on the consumer side, you know, there is some sort of disappointing data. We don't think that the retail sales were as dire as everyone thinks. They have sort of been discounting that, but what was disappointing was the employment data that came out very strongly negative for the first quarter.
Well, Tendani, you mentioned we don't know what's going to happen in Europe at this stage. Do you think it'd be better to hold off on any rate cuts and to keep the potential for rate cuts as ammunition in case Europe does go belly up?
I do believe that, because if they change the interest rate stance now and a few months down the line you find that we need to have a further boost to the economy, that is going to be a problem. Because when they do turn around and start tightening monetary policy, they'll have to do it sooner than we would want. I support the stance that interest rates should remain flat for an extended period. That is going to support consumers, because I believe that they are starting to unwind those high debt positions. And if interest rates remain at this low level and inflation remains at this low level, and there's no reason to believe that is going to be changing anytime in the medium term, that should help consumers really to recover. And I think going on into the second half of the year, that is still going to improve, definitely. I do believe that we might have bottomed down in the employment figures. I think if company balance sheet starts improving, as we're seeing the supply side picking up, we should see a stabilization in the job numbers, and as disposable income increase, spending is going to pick up on the consumer side. We did see quite good vehicle sales figures, which simply means as well that optimism is starting to pick up as to what the economy is going to look like in the future, and consumers are going to come to the picture.
Of course, those jobs numbers that you mentioned, Sizwe, deteriorating to 25.2% in the first quarter of the year. Do you think there's a potential for them to go worse before they get better after the Soccer World Cup? Because there must be lots of employment at the moment for that Soccer World Cup, and those jobs could become open again afterwards, wouldn't they?
I think by and large that's what happened with the first quarter employment numbers. If you look at the employment detail, it seems that a lot of the job losses were concentrated in the in the construction sector, and I think that's a function of some of these big World Cup related infrastructure programs coming to an end. Looking forward, I think that we should start to see some sort of improvement, first stabilization and then an improvement. Because first of all, what happens is that when the economy starts improving, you tend to see productivity growth improve, and then companies start to add workers after that. So if our GDP growth forecast of between 3 and 3.5% over the next 2 years does come to bear, we should see some sort of improvement in the employment rate going forward.
Of course, Tendani, as Sizwe said, the Reserve Bank has quite a benign inflation outlook at this stage. And of course, they are looking 12 to 18 months out with their monetary policy at the moment. But then we have quite a few risks at the moment. We have Eskom coming through with its price hikes from June, the second round effects of those perhaps coming through next year. And if you look at some of the wage negotiations at the moment, particularly the Transnet wage negotiations, workers are looking for 15% increases. And if we're getting those in the public sector, it's really just going to push inflation up in the future, isn't it?
It's interesting because if you look at the inflation expectations that's done by the BER for the bank, you always find consistently that the expectations of labor exceed those of analysts, those of the business sector. I think that is because workers represent the low income end of consumers, where you'll find that the inflation faced by those people, other than food inflation, is quite high. Transport inflation would be higher than what we're seeing on the overall inflation rate. So yes, there are dangers going forward because workers experience a substantially higher inflation than that we see on the total inflation on food, on education, insurance and so forth. That is quite higher. And administered price inflation is nowhere near where we are looking at as overall inflation. So I think those are the inherent dangers that going forward might push inflation higher earlier than we expect. But I think overall inflation for now is going to be benign, as the bank anticipates.
How about the rand, Sizwe? Of course, we had Governor Marcus saying that reserve monetary policy decisions shouldn't be taken on the rand because of the volatility of that currency, but it has weakened from the levels when we had the last rate cut in March, currently around 750. Do you think this is a problem for inflation going forward? Where would you see the rand going?
Look, we've been of the opinion that the rand will remain strong for some time. Reason being that the domestic fundamentals of the rand are very good. They all point to a strong rand. If you look at the rate differential between us and our trading partners, our current account deficit is narrowing. We've got great corporate assets, and you're seeing that coming through in terms of equity inflows. I mean, surge of equity inflows coming in. You were mentioning earlier some of the equity inflows that might come from rumored merger activities. So there's a lot of positives in terms of fundamentals that point to a strong rand. What tends to happen is that there's a very close negative relationship between the rand and risk aversion metrics, such that if there's a little bit of bad news coming out of maybe Southern European debt situations, or maybe Global Investment Bank gets accused of fraud, then you'd see some sort of flow into risk havens such as US government bonds and gold, but that tends to last for a short period of time. When that situation gets revolved, or when you start hearing about bailout packages, risk-loving investors start engaging in risk again, and then you find the rand tends to appreciate. But it's not just the rand story, it's a similar trend with Polish zloty, Turkish lira. So this is sort of an emerging market play. Overall for us, domestic fundamentals, we think, support a strong rand for now. Strong being anything, say, between 720 all the way up to 780, 790.
Tendani, Sizwe, I'm afraid we have to leave it there. If rates are cut this afternoon, I'll be calling you both.